Thank you for joining us at xm.com for today's market comment by Marios Hadjikyriacos. I'm Maria Bashirdiz. It has been a dreadful start to the year for the Japanese yen, which has already fallen more than 5% against the dollar, as a combination of worsening economic data and cautious comments from the Bank of Japan have raised doubts about whether a rate increase cycle lies ahead. Inflation in Tokyo cooled dramatically in January, foreshadowing a similar cool down on a nationwide level. Similarly, wage growth has stalled and household spending is contracting, both indications of even softer inflationary pressures ahead. Reflecting the weaker data pulse, a senior BoJ official signaled yesterday that even if the central bank exits negative interest rates, it's unlikely to keep raising them rapidly. That dealt a heavy blow to the yen, pushing the currency down to its lowest levels since November. Increasingly, it seems that the Bank of Japan won't embark on a rate hike cycle, but is instead looking at a one-and-done increase out of negative rates as inflation momentum is evaporating. For the yen to stage a sustainable recovery, the global economy needs to weaken enough for foreign central banks to slash rates with brute force, which might take some time. Meanwhile, the US dollar is on track for its fourth consecutive week of advances, riding a wave of resilient U.S. economic indicators and fading expectations of rapid Fed rate cuts. All eyes will fall on the annual revisions of U.S. CPI inflation today. Last year's revisions caught the central bank off guard by revealing inflation was hotter than first estimated, ultimately leading the Fed to adopt its higher-for-longer stance on rates. A similar outcome this time could completely close the door for a March rate cut and lower the chances of a cut in May, helping the dollar extend its winning streak. That said, there's no clear indication this will be the case. Either way, traders will have bigger fish to fry next week when the CPI report for January is published. That release could have a larger impact in markets, since it's more up-to-date, possibly overshadowing today's revisions. Oil prices came back with a vengeance this week, recovering a good chunk of their recent losses as hopes for a truce in the Middle East faded, and the U.S. Energy Department projected a sharp slowdown in U.S. oil production growth this year, calming fears of an oversupplied market. Meanwhile, shares on Wall Street are set to close the week with gains of around 1%, with the S&P 500 reaching new record highs. Thanks for watching today's market comment here at xm.com.